Looking at leverage, China has steadily accumulated U.S. Treasury securities over the last few decades. The Asian nation owned $971.8 billion in treasuries as of August 2022. That was roughly 13% of the U.S. national debt. The United States' debt to China comes mainly in the form of U.S. Treasury securities, and currently, China has roughly $1 trillion in U.S. treasuries. In 2020, during the COVID-19 pandemic, a major issue arose when foreigners began selling treasuries. As a result, the treasury market broke alongside the stock market, which was strange to many individuals. This is because when the stock market appears to be declining, people flee into the relative haven of treasuries. And what's currently going on is China's ability to sell up to $1 trillion in treasuries, which could be a bad sign for the U.S. economy. This and more is what we will be discussing today. In this video, we will discuss how China's top banks have begun selling off their entire U.S. asset to collapse the U.S. economy. So watch this video to the end because you'll have all the information you need to plan an unforgettable vacation. Also, remember to subscribe to our channel and click on the notification icon so you can stay updated with our videos. Without wasting more time, let's get started. China's top banks are slowly selling down their holdings of U.S. assets. These fell from over 1,000 trillion to 968 billion in June. You can imagine a fall of 11.6%. This particular trend has affected many things and caused a flurry of comments in financial media. Some analysts and investors fear China could dump U.S. assets in retaliation and that this weaponization of its holdings would send interest rates higher, potentially hurting the growth of the economy. People have observed that many nations which are highly dependent on international trade have decided to hold enough foreign exchange, such as money from other nations or gold. This serves as a means to pay for a year or two of imports. You should also be aware that some of China's holdings of dollars are by the Bank of China, their central bank and equivalent of our Federal Reserve. However, private Chinese corporations also have the chance to hold reserves of US or Australian dollars, euros, and of British pounds. This current situation has also been happening in recent months, and it may be totally the works of the Bank of China or entirely by CFOs of Chinese corporations. Both parties can also have a mix. You just cannot tell unless you have more access to finer resolution data than the monthly Treasury release. In addition, you should also understand that both the Bank of China and private banks may have been holding dollars in forms other than Treasury bonds. For each sector, their money might simply be in bank accounts in London, Frankfurt, New York, and Tokyo. It might be in certificates of deposits or bonds issued by private corporations. So, while the amount of U.S. treasuries owned by China's public and private sectors is an important indicator, it is not comprehensive of all its holdings. Yet another complication is that some small, even minuscule nations hold large values of U.S. treasuries and other financial instruments. According to Bloomberg calculations, China's government is now expected to sell bonds worth over $340 billion for the rest of this year as it taps the remaining annual quota and refinances maturing special bonds. There will also be a total of 2.45 trillion won in sovereign bonds. These funds will most likely make up about 1.66 trillion won of new bonds and nearly 786 billion won to refinance some special maturing debt. But with the way things are going, are we to say that China's moves are meaningless and unnecessary? Well, the answer is no. What this may mean in the long run is that this trend may simply reflect prudent rebalancing. Let's take you back to last year. Okay, it took the United States $1.20 to buy a euro, but as of now, the rate is 1-to-1. China suffered a heavy financial loss on whatever euros they had a year or two or three ago, at least in terms of their ability to buy oil or grain. If you look at the dollar compared to a lot of other major currencies, you will know that it's been strengthening. However, in many cases, it's still below the highs it reached in 2020. When you compare it to the euro or yen, that will give us a different story entirely. So, one of the major issues is that this particular dollar rally has not been as vicious on emerging markets as it could have been. However, if this keeps grinding up and it tends to go up in a quickly disorderly manner, it has the tendency to put more pressure on especially the weaker emerging markets. So, not only the United States, but a lot of countries are at risk already. So, it could be really challenging because there are human decisions involved. It still boils down to what Putin does, and it also depends on what European leaders do. In general, they may have to resort to more diversified energy sources, such as burning more coal and burning oil for electrical energy. This and more can put higher pressure on energy prices globally. However, natural gas transportation is a lot more challenging to transport at a long distance because they can either use a pipeline or go into liquefied natural gas. If one uses a pipeline, we know the capital and the number of years of construction it will require. But the sad reality is still that selling $1 trillion in U.S. securities may really be painful for the U.S. Another risk is that if China sells it all on the eve of a possible conflict, don't you think all other Treasury holders will want to sell theirs too? As such, the value of the U.S. Treasury bond will fall deep down. And that's it for today, guys. If you enjoyed this video, ensure you subscribe to this channel and give this video a like. Thanks for watching. See you in the next video.